Why should anyone trade futures? This was a question that I was asked when I was making a presentation in a college here in Jammu. And the question that was basically asked is, why would anyone want to trade futures given that it is so risky? There are many answers to this, but broadly speaking, there are two reasons for trading futures. First of all, it allows us to take a sell side position on any security that we feel might not do well. In other words, a future trader does not necessarily need the market to only move up, but the future trader can also profit when the market is moving down. And this is a huge edge if someone is interested in being in the market for a long duration of time. So let us assume that you anticipate having a trading career of 10, 15, 25 years. It is reasonable to assume that there will be a patch of 2, 3, 5, 7 years where the market could be trading in a bearish trend. During such a phase, the futures trader actually has an advantage over all other traders in the market, particularly the equity buyers, as the future trader can actually look forward towards gaining in such a phase of the market. So the first reason why anyone would want to trade derivatives in general is because it allows the trader to take up sell side positions in the market. The second reason why we should trade futures is basically given in this table here. In this table, we can see the cost associated with trading. So let us assume someone is bullish on a particular stock which is currently valued at rupees 1000, and the individual buys 5000 quantities such that the purchase value is rupees 50 lakh. Now, assuming that for some reason the individual had to square off the position at the exact same value, the overall cost of trading this 1 crore rupee would be close to 11,000. Similarly, if this exercise were to be repeated in the futures segment, the cost associated with trading would just be 1000. In other words, for the given unit value, a futures setup is as much as 10 times cheaper than the corresponding equity setup. Now, if an individual is going to be taking positions very often in the market, there is no ambiguity that a 10x difference in cost gives us a compelling reason to be in the futures segment. Similarly, if we compare the futures expense with the options expense, we will see that in order to trade the same 1 crore rupee in value, we are spending close to 10,000 rupee in the options segment. In other words, here it is 9,234. In other words, it is safe to assume that the futures trading is 9x cheaper at least, or options is 9x more expensive than the corresponding future setup. Now let us assume we both are long on a stock, let's say Reliance, and we both have the option of going long on Reliance either by buying equities or by buying future or by buying an option. Now, when you factor these three, for all things remaining constant, we will see that since the cost associated with futures is the lowest, therefore the potential of realizing profits from the position is the highest. 1 crore rupee might sound like a big value, particularly if you have small trading accounts of less than say 5 lakhs or 10 lakhs in value, where the individual might feel that they will never turn over such a never have a traded value of such a value. But I can assure you that 1 crore is fairly easily reached, and if you spent a couple of years in the market and if you're an active trader, chances are you're trading far greater than this value. Further, I would like to add that let's say we were to reduce the traded value from 1 crore to 10 lakh, then typically we would expect that the cost would also dip by 1/10. But here we will see that the cost does not dip by 1/10, but rather by a fraction of it. In other words, it becomes much more expensive to trade if your unit costs are lower. So for example, if I were to reduce it by another a tenth of a value, so now we would expect 1/100th of the overall cost in the system. But we can see that where 100 times this value was supposed to be 11,000, we can see that 100 times the current value is 12,738. In other words, the lesser the quantity you trade, the more expensive trading becomes, because there are certain fixed costs associated with it, and this is obviously inclusive of the zero brokerage that is currently marketed. In the event any individual is using a full service broker such as a bank or any other premium broking service, the costs are obviously going to be much higher. Therefore, in order to minimize cost, not only do we have to select the correct instrument, but we should also strive to hold on to the position for as long as possible, so that the cost realization on a per day basis for the trader is significantly lower. In order to elaborate on that point, I will show you the P&L that currently I am experiencing, and we will focus on how much it costs us to trade. So here on the first slide, I have basically selected the current financial year, and we can see that I have realized gains of 17.34 lakhs, and the cost associated with it is just 13,500 rupees. Now, anyone, whenever you are looking at the screenshots of other traders on various social media channels, I will encourage you to, in addition to looking at the P&L that is realized, also focus on the cost that is associated with trading. And here you will see that at just mere 13,000, we can see that not only is it just a small fraction of the 17 lakh that is realized, but an even smaller fraction of the 35 lakh that is still unrealized in the position. So which means in order to generate notional and unnotional gains of close to 52 lakh rupees, it costs us just 13,000 rupees in the future segment. But when the similar setup is put into the equity segment for the same period, we will see that in order to realize the 1.89 lakh rupee, I have had to pay 96,000 rupees in the cost, making the realized gains to just 88,000 rupees. This just goes to show that the 10x increase in cost becomes disproportionately higher when you're taking smaller trades, that is smaller quantities, and doing this several times. And the cost associated with trading take up a sizable chunk of your overall trading gains. Since we can see in this chart that equity is several times more expensive than trading futures, but options are even more expensive than trading equities, it is reasonable for us to simply rule out trading options on the basis of price alone. Now, in addition to why we should rule out options, in addition to the high cost associated with trading, I would also like to elaborate on what exactly the option means. So let's just say I were to go to the Zerodha login. Just one moment. In order to so here, as soon as we enter, we can see this, that 9 out of 10 traders are booking losses as per the risk disclaimer, which is obviously not true. Over a 5-year period, only 1 out of 250 traders is actually very profitable, and 5 out of 250 traders in total break even or do better. On an average, the loss maker registered a loss of rupees 50,000. Since on an average an individual client has less than 2 lakh rupee, it is already representing more than 25 to 30% loss on a annual basis. Over and above the net trading losses incurred, the loss makers experienced additional 28% as transaction cost. Now, it is very convenient for the exchanges to say that the transaction costs account for almost a third or the fourth of the overall trading expense, overall losses. But if they were so concerned about it, then they should not have increased STT by 25%. The exchanges have somehow decided to protect the retail investor by making trading so difficult that they should be discouraged to enter. So while it is very easy to discourage people to not trade, I think it is much more tough if you could recommend a solution on how else to make money. If you are working in a 9 to 5, 9 to 9 kind of a corporate setting, how else will you make money? You will be entirely dependent on your job, and where is the potential of financial freedom? It is not easy, and it is not in the capability of everyone to be employed and to simultaneously start a business. I couldn't do it when I was employed, and from all the constraints that I had, trading was the most convenient, not easy, but the most convenient vocation to pursue. But such high costs, such high increase, such expensive margins required to trade over the last 4 to 5 years has dissuaded or made it difficult for many traders to be profitable. This has not only impacted retail traders, but it impacts all businesses that are associated with servicing retail traders. Overall, the exchange's approach towards the market is extremely conservative, very hawkish, and uncalled for. Given that there is absolutely no risk of default, the obscene premiums and the high STTs do not make sense. Further, what does not make sense is the fact that a trader who risks so much more, provides so much more liquidity, and so much greater service to the investment community in general has to pay 30% taxes as compared to a long-term investor who has to pay 10% taxes for simply making a guest appearance in the market. When both the individuals are risking, why should there be a difference simply because of a particular individual decides to settle the contract sooner? It is my opinion that the current norms of the regulator need to be looked into. They further add that those making net trading profits incurred 15 to 50% of such profits as transaction cost. So they are saying that in general, a trader pays up to 15 to 50% of their overall profits in transaction cost. And here you can see that in my overall 1.9 lakh in the equity segment, I have paid almost 95,000, which is 50% of the total gains has been transaction cost. But if you compare the same thing with the future segment, you will see that in order to reach a potential of 50 lakhs, I have paid less than 15,000. The gains, the transaction costs now are extreme fractions of the overall trading cost. Now here in this, I would just like to discuss. So currently we can see that Nifty is trading at 23,290. So I will just add a 23,300 call for June, and I will add a 23,300 put for June. Now let us understand what is this saying. We can see that the Nifty 23,300 call is trading at 350 rupees. What it basically means is that that we are paying that unless Nifty moves at least 350 rupees above this particular call option, which means that on the period of expiry, Nifty must be trading at a value greater than 23,658. Only then will the owner of the security actually start seeing profit. If Nifty closes at any value below 23,658, which is 23,300 plus the premium of this, the owner of the security will lose money. And if Nifty closes below 23,300, then the owner of the security will lose full money. Similarly, we can see that the 23,300 PE is valued at approximately 300 rupees. Here it is given 316. In other words, only if Nifty were to correct till at least 23,000 at the time of expiry would the individual break even. If Nifty were to close above 23,300 at the time of expiry, the individual will lose full money, which means that here from the current price, the individual needs the market to move at least 325 points on an average for them to start making money. We will compare this with the Nifty future for the same period. And here you will see that the Nifty with spot value, which is at 23,300 or 23,290, has a future of 23,335, giving it a premium of only 45 points, which means that the remaining 23,290 points is intrinsic value. In other words, at the end of June, Nifty simply needs to close at 23,335 at spot values, which means 45 points more in the remaining 3 weeks of trading for this security holder to come into profit. Whereas if the future holder is to sell this, they gain a premium of 45 points. Now let's just focus on the long side. So I will remove the put option for now, and we will see that while both the traders are bullish at 23,300, both the traders decide to buy the market. If Nifty were to close at 23,650, the trader who's trading futures would be making 300 points, whereas the trader who's holding the option would make 0 points. Coupled with the fact that it is 10 times more expensive to trade the option. While both the traders were bullish and the market did indeed go long, we will see that the option trader does not make loses a huge chunk of his gain, loses a huge chunk of the market move in simply to cover the premium of the option. These premiums are too high, making options an undesirable product to trade. If we are trading delta, then we want to buy that security on leverage which has a very high component of price as the intrinsic value, which is only possible in the future segment. And further, now let us just see if we add Nifty July and Nifty August. Now we can see that the Nifty June series is at a 45 point premium. Logically, we would expect the July series to be at a 90 point premium. But here we are seeing that the July series is at a 150 point premium, 160 point premium. And the August series is at a 270 point premium. That's the reason why, while Nifty grew by 2%, we can see that the corresponding futures grew by significantly lesser than 2%. In other words, the futures trader is also vulnerable to how the VIX is moving. If the market is moving up but the VIX is coming down, the future trader is also going to lose out on options, on premium. One of the ways of making sure that you are on the safer side of it is that if you intend to hold on a future for a longer duration, you want to see at what point the three future contracts show the least divergences in the premium. And once you have that period where the contracts are showing least divergences in premium, you are incentivized to take on the August future rather than taking on the June future. Currently, there is a lot of divergence in the premium, and therefore an individual trading Nifty would be more incentivized to trade the June series rather than the August series. But this is not always the case, as I will show you in the positions here. You will see that I have Abbott for June, but I have Adani for August and June. I have Apollo for August, and you can see I have Dabur for July, Reddy for July. So these positions are basically coming from comparing the premiums for various expiries. Sorry. So I hope that in today's video we have an understanding that that equities are several times more expensive than futures, and options are also several times more expensive than trading futures. Futures allows us to trade the long side and the short side. Futures are very effective for defined periods such as 1 to 3 months, and in the extremely short term they completely outperform equities for a given market move. Also, since future contracts have so much of value because of the intrinsic value of the contract is captured to a great extent, it almost forms 99.5% of the overall contract value. The trader loses very little, and if the trader can make adjustments for the premium that the future is charging by comparing various expiries, they can get a good value so as to reduce the trading expense. This reduction in trading expense is seen in our own profile, where in order to in order to gain 50 lakhs, we are simply making an expense of less than 15,000. I hope this explains why we do some things and how we go about approaching these things. I thought that this will be useful to share with most traders in the period of high volatility. I wish you the best for the remainder of the week. Take care.